There's a piece of research that should make every property investor in Australia stop and think. 22% of investors exit within their first year. 22% of property investors in Australia sell within their first year of buying. Nearly half exit within 4 years. Those numbers come from an academic research out of an Australian university, and they've been consistent across different study periods. This isn't a blip in one particular market cycle. It's a structural pattern in how Australians engage with property investment and how frequently they disengage from it. In this video, I want to walk you through what's actually driving those numbers. Because the typical narrative, property is risky, a lot of people lose money, doesn't capture the nuance. And without understanding why people exit early, you can't meaningfully reduce the probability that you will be in that cohort. Let's start with the data itself, because context matters. The research distinguishes between voluntary and involuntary exit. Voluntary exit includes selling for profit, changing investment strategy, or responding to life circumstances. A divorce, a move overseas, a change in financial priorities. Involuntary exit includes selling because of financial stress, defaulting on mortgage obligations, or being forced to liquidate because of cash flow problems. Early exits, particularly in the first 12 months, are disproportionately concentrated in the involuntary category. These are not people who found a better opportunity. These are people whose financial position couldn't sustain the asset. And the research consistently points to three causal factors. The first is cash flow miscalculation. This one is deceptively common. People do the numbers at purchase. They look at rental income, they calculate the mortgage repayments, and the difference looks manageable. But the real holding cost of a rental property includes more than mortgage repayments. It includes property management fees, which typically run between 7 and 10% of rental income. It includes maintenance and repairs, not just the dramatic ones, but the ongoing accumulating costs of keeping a dwelling in rentable condition. It includes landlord insurance. It includes council rates and water rates. It includes the period between tenancies. Even in strong rental markets, there are transition costs. And it includes the impact of rate movements on variable rate loans. When you add all of those up, the cash flow position looks materially different to what the basic yield calculation suggested. And for buyers who entered with a thin financial buffer, those additional costs aren't just uncomfortable, they are destabilizing. The practical implication: before you buy, model the holding costs at the full, detail level, not just rent minus mortgage, every line item. And then ask yourself, if my rental income stops for 90 days, what happens to my financial position? If the answer is it becomes very serious very quickly, your buffer is probably too thin. Second factor is life events. This is the one the financial modeling can't fully anticipate. But preparation can help. People's lives change, relationships end, income shift, family circumstances change, major expenses arise unexpectedly. The investors who navigated these events without having to liquidate their property possessions typically had one thing in common: adequate liquidity buffers. They maintained cash reserves that could carry the asset through disruption without forcing a sale. The investors who exited didn't necessarily make worse property decisions. They just didn't have the financial runway to hold through the disruption. This is a point that doesn't get enough airtime in property investment content. The quality of your entry decision matters, but so does the quality of your balance sheet at the point of entry. You're not just buying a property, you're buying a position that you need to be able to maintain through periods of unexpected friction. Having appropriate liquidity isn't conservative financial management. It's the foundation of a holding strategy. The third factor is what I would call pre-purchase strategy deficit. The research is fairly unambiguous on this one. Investors who entered the market with a clearly defined investment strategy, specific criteria for what they were buying and why, a holding plan, a defined time horizon, had materially better outcomes than investors who entered with a general intention to invest in property. The strategy deficit shows up in a few ways: buying a property because it felt right or because someone recommended it, without a clear framework for evaluating whether it met specific criteria; entering a market for reasons that were predominantly cyclical. Someone said it was going to go up, rather than based on durable structural demand indicators. Failing to define what a successful outcome looked like before purchase, which means there's no anchor to hold you in place when conditions become challenging. When things get hard, and at some point they always do, investors with a clear strategy have something to return to. They can ask themselves, is the original investment thesis still intact? Are the structural demand indicators still in place? Has anything fundamentally changed? Or is this just a temporary cycle? If the answer is that the thesis is intact, the rational decision is to hold. Without a strategy, you have nothing to return to. The only input available is how you feel right now. And when conditions are challenging, how you feel right now is not usually pointing towards holding. One of the most useful things we do in our early conversations with potential clients at OB property buyers is help them build that strategy framework before they commit capital. It's not glamorous work, but it's the work that determines whether you're still in the game in 5 years. If that's a conversation you would find useful, link to a no obligation discovery call is in the description. Now, I want to make sure this video doesn't sound as discouraging because that's not the intent. The 22% figure isn't an argument against property investment. It's an argument against entering property investment without structure. The investors who stayed, the ones who build multi asset portfolios across cycles, weren't necessarily better at picking properties. They were better prepared to hold them, and the preparation is accessible to anyone. It requires honest financial assessment, adequate liquidity reserves, and a clear investment strategy with predefined entry criteria. None of those things require genius. They require discipline and the willingness to do the work before you commit capital. The market will always test your position. The question is whether your position was built to be tested.